Okay, so it's 2 minutes past 1. Let's make a start. Thank you very much for taking the time out today to spend some time with us. I'll just do some quick introductions. I'm going to pass you over to Richard Burden shortly. Richard is the Head of International Sales at Canaccord, and he will pass you over to Justin Oliver, the Deputy CIO. This is our third in this series of webinars regarding COVID. And each one has been extremely good and extremely useful. We do have a Q&A at the bottom of the webinar, so please, as we're going through the presentation, feel free to put some questions down there and we will come back to them at the end. With that, Richard.
Richard, you're on mute.
Good morning, afternoon or evening. Welcome to part 3 of our global market update. I'd like to take this opportunity to thank you for your attendance on this call today and hope that you find the information useful and informative. CGWM specialise in managing investments. We are aiming to be the outsourced investment home of choice in our core markets. The process that my colleague Justin will run through this morning is a glimpse of the investment oversight and philosophy that underpins the portfolios and services we offer. CGWM currently manages circa 24 billion sterling of assets on behalf of individual clients and institutions. I'm now delighted to hand over to our Deputy CIO, Justin Oliver, to present on the ongoing implications of the coronavirus and what next for markets as a continuation of our 2 recent presentations. Over to you, Justin.
Okay, thank you very much. Rich, can I just confirm before we start, you can hear me okay? And you can see the slides up in front of you. Perfect. Well, first of all, thanks very much, everyone, for listening in today. And thank you to Alex for inviting us to speak again. We really do appreciate it. As the invite set out, it's been about 6 months now since we first really entered the coronavirus pandemic. So January was really when it really first started to come to the attention of the wider public and financial markets. And as we're aware, that culminated in a very sharp fall in stock markets across the world, which ended around March. Since when we've seen there's been a substantial recovery. So what we'd like to do today, and obviously the third of the series, is to set out what our thoughts are in terms of that recovery process. Is it going to continue? Can we expect some sort of relapse? And really try to bring out a few of the perhaps longer term implications of what we've been through this year. Look, again, some of these are questions which we won't necessarily have the answers to because there are sort of unknowable implications as a result of it. But I think at least it will highlight that we need to be starting to ask the right sort of questions about how will the global economy and how will financial markets operate moving forward. So to begin, as we always do, just with a little bit of a market background, and I won't spend too much time on this. Where have been the places to be this year? Well, clearly, with the benefit of hindsight, if you were going to start a portfolio at the beginning of January, you'd have wanted to hold gold, which has performed extremely well, and again is up sharply as we speak. So looking at today, it's up another 5%. You'd want to own some technology stocks. And again, we've kind of discussed how those working from home and staying from home companies have performed extremely well so far this year, really building on a track record of outperformance. China, perhaps surprisingly for some, given it was the epicenter of the coronavirus pandemic, but it was clearly also the first economy to kind of come out of that, or the other side potentially of the virus. So again, Chinese equities have done very well, and similarly US Treasuries. I think it's noticeable that actually the best performing assets this year have been a mixture of what we call sort of risk on assets, so global technology and Asia, and actually also those defensive assets, so US Treasuries and gold, which perhaps highlights why we always think it's important to make sure you've got a diversified portfolio. And if you'd had that mix of growth and defense, you'd have done extremely well so far this year. Those of you who listened to us before would have seen this chart before, and it's one I quite like, because again, it just sets into context what we've seen this year relative to other S&P bear markets. So for those of you who aren't familiar with it, what we've attempted to do here is just show all the S&P 500 bear markets going back to, to the 1960s. We've standardized them. So the previous bull market ends on the 100 level, and then against the horizontal, we put the number of trading days there. So what we've seen obviously this year was the sharpest or the quickest move from a bull market to a bear market, which was over a course of 16 days. Normally it takes about 10 months, but obviously with everything that was going on, it was a very, very sharp moves. But then that's been followed by an extremely strong market rally. So the second quarter of this year was the strongest quarter for the S&P 500 since the fourth quarter of 1998, which for those of you who are familiar with that period, 1998, we were getting towards the peak of what was a bubble in technology stocks at that time. So again, markets fell very sharply, but then rebounded extremely sharply. And then we've just here put the sector returns for the S&P 500 over the year to date. And again, there's actually one key standout this year, which has been the performance of technology stocks. So again, if you're looking at the IT sector as a whole, it's been up 16% this year. But actually, what's not immediately obvious is that some of the other standout performers, such as consumer discretionary and communication services, the performance of those sectors has also been driven by technology. So consumer discretionary is effectively Amazon. About 45% of that sector is the Amazon weighting. So again, that's driven up. And also in terms of communication services. So communication services includes companies like Facebook, Alphabet, and Netflix, bizarrely. So those have been the areas to be, and also clearly again, healthcare. For unsurprising reasons, given everything that's gone on. So that's a little bit of the the background. So what we're more interested in clearly is where do we go from here? Where are we moving in 2020 and potentially into 2021? This remains one of my favorite quotes of all time, which is from Donald Rumsfeld, who was the US Secretary of Defense during the Iraq War. And effectively what he said is that there are things we know, there are things we know we don't know, and there are things we don't know we don't know. And I think in this sort of environment, actually, there's quite a few things that we know we don't know. And that involves things like the coronavirus itself. Have we brought the situation under control? Is a vaccine, which the market is clearly hoping for at the moment, is that a realistic possibility? What are some of the longer term implications for economic growth around the world? And again, there's a lot of questions being asked about how strong the recovery will be and actually how long lasting it will be. And also a lot of questions in terms of markets. As we've touched on, markets have been very, very strong during the second quarter, which is actually a bit of a contrast to what's going on in terms of the global economy, where growth is still quite weak. The coronavirus situation itself hasn't been brought under control, but almost markets have kind of discounted that at the moment. They almost seem to be ignoring what's going on 2020 and instead focusing on 2021 and 2022 and what's going to what the potential of the recovery that we'll see there. So again, in terms of our discussions today, we're going to touch on each of these and try to bring out a few of the key points as we see them. Turning first to the the coronavirus situation itself, I think the key message here is that cases are still rising around the world. Now, the locus of the infections has shifted. Clearly, it started in Asia, it moved to Europe, and now it's very much across the American continent. And as we stand today, there are almost 15 million cases. There have been about 615,000 deaths. And actually this chart here brings out the number of new daily cases that we're seeing. And again, you can see that that figure is still rising and still rising quite sharply. The US is very much leading the world in terms of new cases, and despite what Donald Trump is saying, it's not just because the US is testing more than other people, but it's a fact that actually the situation there is a lot worse than it is in other countries. That's bad situation in the US is being followed by Brazil, where there's about 2 million cases. India too has also seen a sharp increase. They're up to about 1.1 million cases there, and Russia's coming in at about 780,000. So clearly, again, we've got to be careful about making country by country comparisons, because different countries have different metrics for how they count new cases. There are a few issues in terms of data integrity, but the key message, as far as we're concerned, is that the coronavirus situation is a clear and present danger still for the global economy, even 6 months into the situation. The other thing that's obviously to note is the comparative success of regions such as Europe compared to other regions, and in particular in this case the US. So what we've done here is just show the number of new daily cases in the US in red, and the line is the 7-day moving average, against the situation in Europe. And what we've done here is just take Europe's 5 largest countries, which in this case is the UK, Germany, France, Italy and Spain, and between those 5 European countries and the US, the populations are broadly similar. I mean, within about 6 million of each other. And again, you can see here that the situation in the US is not looking good at the moment. While we can broadly say that Europe has seems to have brought everything under control, the number of daily cases is increasing in the US, and that, in a way, that was always going to be a danger, partly because of the way that the US population values their freedom and independence. You may have seen in the news protests about having to wear masks, etc., etc. Now again, we're not making this is not to have a go at the way the US is handling it in any way, shape or form, but it does show that actually cultural differences can sometimes make a big difference, and it seems to be having a big difference in terms of what's going on in the US at the moment. And again, just breaking that down at the moment, there are a number of key states which are driving those cases in the US. So in particular, Florida, California and Texas, on the chart on the left-hand side there, you can see the number of daily cases is increasing at an alarming exponential rate. And clearly that's having an impact in terms of the activity in those states. So on the right hand side there, we've got the Google mobility indices. So that's just Google tracking how much people are moving, how much they're going to workplaces and and going to parks, etc., etc. And you can see actually what we did, what has gone on in the US this year is that some of the lockdowns were eased. So from April and May, the mobility of the US population started to increase again before it started to drop off again more recently. And clearly again, that's going to have an economic impact in terms of the US in particular. The other point, and again, the key question, the question we get asked a lot is, well, what are the hopes for a vaccine? Now, again, clearly we are not medical professionals, but we do know people who are, and again, we've been canvassing them, very frequently over the past weeks and months, just to try and build up our understanding of whether a vaccine is likely, and if it is likely, how quickly that may be put through. Now, there are lots of trials underway. By some estimates, we're seeing anything up to 200 trials, and actually some of those trials are producing encouraging results. So Moderna is one, and again, I've just put the share price of Moderna there on the right hand side just to show how the market has locked on to what was an encouraging trial. But the key point is not to get too excited about that. So in terms of Moderna's trial results, it was based on just 45 people that did produce a good antibody and T-cell reaction in terms of patients. But there's a long way to go between testing 45 people and getting a vaccine out to the wider population. Similarly, over the past day or so, the University of Oxford and AstraZeneca also did a trial. It was a larger trial of about 1,000 people, and again there were encouraging results from that in terms of a response from the body in terms of producing antibodies, in terms of producing T cells. But again, we need to take care and not extrapolate success as a result of that. It typically takes a long time from the first phase 1 trials till a vaccine is actually produced. As we've shown there, courtesy of the FT, which put this in helpfully yesterday, normal development of a drug would be expected to take 10 years from discovery through to preclinical trials, etc., etc. The COVID-19 vaccine, if it comes, and it is still a big if, given that there's never been a vaccine produced for a coronavirus, realistically is still, we think, going to be sort of 12 to 18 months away. So vaccine is a possibility, but what we're saying is, from our understanding of the situation and from speaking to the medical professionals that we do at the moment, it may not be happening this year, which I think some governments and some policymakers seem to be pinning their hopes on. So that's that's the vaccine situation. Turning on to the global economy as a whole. There has been better economic news recently. Now, it's not necessarily good news, it's just less bad than perhaps people were expecting, but actually very often that's enough. The news doesn't have to be good for markets to go up. It sometimes just has to be not as horrific as people are expecting. And again, we can plot that in terms of these indices, which are sort of Citigroup economic surprises. They're just basically tracking whether the economic data which comes out is surpassing expectations or not. And again, the US actually has produced better numbers than were expected. As I said, not necessarily good numbers, but better than perhaps feared. Similarly, we've seen that in terms of the global economy as a whole, and also in terms of Europe. So in a way, the markets are ignoring the actual numbers which are coming out, and instead focusing on whether those numbers were better or worse than expected. So that's the good news. In terms of the slightly more sobering news, as we've known, as we've warned in the past, we will be expecting to see some truly horrific economic data numbers, and we have seen those over the past 2 or 3 months. The problem with things like the GDP figures, so gross domestic production figures that we see, is that they can be very out of date, they can be very stale, they're over a quarter and they're not produced the next quarter, so they don't really give us a sense of what's going on in the economy at the moment. One of the things we can look at are indicators by people such as the Atlanta Federal Reserve, who try and plot a more real-time estimate of what's going on in terms of the US economy at the moment. And you can see here that actually economic activity plunged, unsurprisingly, in March and April, and then we have rebounded back. Again, we've got a long way to go before activity is back to those pre-coronavirus levels, but we're on the right track to recovery. Again, partly that will depend on how the coronavirus itself evolves moving forward. This is one of those, is this good news or bad news slides. So again, looking at, say, the US unemployment picture, how many people have been filing for jobless claims. This shows on the left-hand side, at the peak, so back in March this year, close to 7 million Americans filed initial jobless claims in that week-long period. Now, and the most recent figure that we've got, a new 1.3 million Americans have filed. So clearly that's far better than 7 million, but it's actually still 1.3 million people in the US have recently filed for unemployment. So again, it's a bit of a sobering thought, and I think we need to put that into context. Again, one of the issues that people still aren't sure about, so one of the known unknowns, is how many of those job losses that we're seeing at the moment are just temporary, and how many actually will be permanent. Because actually, if it's just a temporary unemployment, that's fine. A lot of the fiscal stimulus which the US is putting through will help get households through that more testing period. But actually, if people can be hired back, there needs to be companies there to do it. Otherwise, they're going to become permanently unemployed. And so while we have seen the number of temporary layoffs decrease, actually the number of permanent layoffs has also increased. So we're looking at a situation in the US at the moment where there's about 11% unemployment. That was the most recent figure. There were a few data collection issues which kind of indicate that actually the true figure itself was a lot higher than that. But again, that's kind of an evolving situation. Yeah, and clearly again, what goes on in the economy makes a difference to the stock market. So here we've just plotted what happens in terms of the purchasing managers indices. So anything above 50 is indicating expansion, anything below 50 is indicating contraction, and just plotting that against what has happened to, in this case, the S&P 500. And you can see actually good economic news or positive growth typically leads to higher stock market returns and vice versa. So we do, I think, need to see an increase in activity to support stock markets at these sorts of levels. I thought it's also instructive to have a quick look at what's going on in China at the moment, because clearly China was first into the lockdown and was also one of the first economies to come out of lockdown. So it might give us a roadmap about what we can expect moving forward. So again, this is just Chinese economic growth quarter by quarter. You can see when the coronavirus had an impact. Which was basically in the first quarter, where the economy contracted quite significantly, and there has been a bounce back clearly as the lockdowns have been eased during the second quarter. But I think the point here is that actually the rebound that we've seen hasn't taken even the Chinese economy back to the sort of growth rates that were seen before the coronavirus pandemic. And that's because whilst manufacturing might be sort of broadly back to neutral, the services sector, the services part of the economy is still operating well below its potential growth rate. So people are still relatively reluctant to go out and spend. So we've seen retail sales in China fall over the past 4 months, even though the lockdowns have been generally eased. So the point here is that actually governments can do all they want to release lockdowns, but actually if the population itself doesn't feel safe, they still won't necessarily go out to spend, they won't go to restaurants, they won't go to cinemas in the sort of numbers that we've seen in the past. So that's clearly a key consideration moving forward. Actually, it's the public confidence in the situation and whether it's been brought under control, more than just whether an economy is fully locked down and whether those lockdowns are being eased. And absolutely a big debate that's been going on, and the subject of much research is, okay, we think we're in an economic recovery, but what sort of shape will that economic recovery be? Will it be sort of V-shaped, so we see a sharp contraction followed by a sharp recovery? Or will it be sort of more of a U-shaped where it takes a while for growth to trough and then slowly picks up again before accelerating? We've seen lots of numbers. Is it going to be an L shape where effectively we're not going to see much of a bounce back at all? Is it going to be a sort of square root shaped recovery where activity collapses, bounces back strongly for a short period of time before flatlining? And that's a lot of what people are trying to get their hands on and trying to understand at the moment. Now, if we're looking here at the Chinese PMI figures, it will kind of indicate that actually it's a V-shaped recovery. You can see the falls there that we saw in February and a bounce back. But I think it's important to remember what the purchasing managers indices actually show us. Now, anything above 50, as I said, indicates expansion. Anything below 50 indicates a contraction. But actually what this does is plot the expansion or contraction on the previous month. So the sharp fall there we saw in February was followed by a bounce back, but actually the number itself was still below 50. So all it means is the economy contracted, but at a slower rate than it did in February, and similarly in terms of the April figure. It's only really been over the past couple of months that activity month on month has started to increase again. There is nowhere near taking us back to the sort of levels that we've seen previously. So there's a long way to go, I think is what we're saying in terms of the recovery. Also a big debate in terms of inflation. Now the consensus view about inflation is that clearly, with the situation we're in at the moment, inflation is probably not going to be a problem, because again, companies will find it very, very difficult to push through price or cost increases for products. I think workers will still feel hesitant to demand pay increases, etc., given the large unemployment. So actually, inflation is expected to remain under control for the foreseeable future. And actually, that's a very, in a way, that's a good thing, because what it means is that the central banks won't necessarily be worried about raising interest rates to control inflation anytime soon. There's a slight downside in that if inflation becomes deflation, then actually we're in all sorts of trouble in terms of the global economy, because deflation is very difficult to come out of effectively. What we've done here is just literally plot what the market's expectations are for US and Germany inflation over the next 10 years, so via break-even inflation rates. So actually inflation is looking very controlled. It's certainly not an issue in the short term, and it's something that central banks will take a little bit of comfort in for the time being, but they will be closely paying attention to it, because the last thing they're going to want to see is those figures dropping even further and dropping potentially towards that zero sort of level. Fiscal stimulus. I think if there's one thing that's happened this year, which is undoubtedly a good development as far as the global economy is concerned, is how governments have stepped up to the plate and spent the money that they've needed to do to get people, households, companies actually through this more difficult period, through effectively, as far as the US is concerned, transferring money directly to those households which might have been impacted by unemployment. And again, we can see here on the left hand side, really the fiscal stimulus as a percentage of the GDP, actually led quite surprisingly by Germany, who was typically been quite a frugal nation. They've been hesitant to run budget deficits, but you can see actually they've provided a lot of stimulus for their economy, followed by Italy, Japan, and the United Kingdom. So that's undoubtedly a good development. I think the other point to note is actually the government's response to the coronavirus pandemic has far exceeded what we saw in the global financial crisis of 2008, 2009. And that's what we show there on the right hand side. Governments needed to step up to the plate to get households through this, and they've very much done it. The key question is what happens effectively moving forward. Some economies will still need to see further fiscal stimulus. And I think the US is probably key within that. Their initial fiscal stimulus program came in about $3 trillion. There are further negotiations going on between the Republicans and the Democrats at the moment about what happens moving forward, because actually some of those programs are due to expire. So there's a $600 top up to unemployment benefits that's due to expire at the end of July. There was the payroll protection program, which stops accepting new applicants around the middle of August. Also things like forbearance in terms of mortgage debt, freezing student debt, etc., etc. A lot of those programs are due to run out, and it will be instructive to see what sort of package that the US puts forward moving forward. The Democrats want something akin to what we saw last time, so about $3 trillion. The Republicans, which tend to be a more market-oriented economy, don't like big government, are pushing more for something like $1 trillion. But we've got things like the US election to factor in, and you're not going to have one party wanting to be accused of holding back the US recovery. So those are issues moving forward. So I think again we can expect to see further fiscal stimulus measures if they're needed, and certainly in terms of economies like the US, there is no doubt that they are needed. That's the good news. The bad news is, it's got to be paid for somehow and sometime, and the result is that a lot of governments are running massive fiscal deficits, or expected to this year. So these are figures from the IMF, who in April tried to estimate how much the fiscal deficit was likely to be for various countries. And you can see the US is really leading the way there, but also followed by the advanced economies generally. On the right hand side, we're showing what that means for the debt levels of the global, of those various countries. Yeah, and clearly there is an increase in debt generally, and again that has to be paid for. Now, how that all pans out is one of the imponderables at this moment in time. Effectively, there's three options open to governments about how to pay down that debt. One is to inflate it away via inflation. One is to grow your way out of it, and the other, which is almost unthinkable at the moment, is some sort of default. Now, I think we can rule default off the table for the time being, but I think governments will be looking at those growth and inflation options to try and reduce those overall debt levels for the over the longer term. But actually, for this moment in time, they're not actually that concerned about it. Just moving on. US election is increasingly going to play a part moving forward. We'll also have to be very careful about polls of our electorate at the best of times, particularly as far as the US is concerned, because clearly it's electoral college votes that make a difference. The key point to make here is that actually the odds of a Democratic clean sweep, so controlling the House, controlling the Senate, and actually having the president being Joe Biden rather than Donald Trump, have all increased markedly. So actually it's looking odds on for a Democratic clean sweep at this moment in time. But similarly, this sort of time 4 years ago, that was also the case with Hillary Clinton and Donald Trump. So a little bit of care as far as that's concerned. I think clearly if Donald Trump doesn't get in, some people will be very happy about that, clearly. Actually, the stock market may not be, because for all his many faults, the policies that Donald Trump has put together and put in place are generally market supportive. So he's lowered corporate tax rates, he's lowered federal rates, he's gone for the American first sort of attitude, which actually the stock market has generally liked. Joe Biden, on the other hand, if he does win, will look to raise those corporate taxes. He'll be looking to raise income taxes again. He'll be looking to raise minimum wages, etc., all of which might be market unfriendly. So I think we need to be a little bit careful what we wish for here. While some people will be very happy to see the back of Donald Trump, actually the US stock market may not respond well to that situation. Very quickly, in terms of what may happen to various assets moving forward, US dollar is a question we get asked a lot. Typically, the US dollar is a counter-cyclical currency, which means that actually as the global economy strengthens, the dollar tends to weaken and vice versa. So if we do get a continued recovery in the global economy, I think it's reasonable to expect that actually the US dollar would weaken. A couple of other factors would tend to lead us to that conclusion as well. Principally the fact that actually US interest rates, which were much higher than other countries across the world, it's no longer the case. US interest rates are also zero, slightly negative in some of the European countries, but actually with inflation expected to be higher in the US as well, actually real rates in the US are in fact lower than they are elsewhere in the world. So I think there will be a headwind for the US dollar moving forward, and we wouldn't be surprised if we saw the US dollar continue to weaken moving forward. One of the biggest issues that we're all trying to get to grips with is, in terms of the US stock market, and what happens in terms of that performance moving forward. Clearly, the US stock market has moved very much ahead of global economies, and again, that's surprising to many people. But really, the stock market's looking at two things. Firstly, it's ignoring what's going on in 2020 and instead focusing on 2021. And we can see here that actually corporate earnings in corporate America are expected to beat their 2019 peak at some stage by 2021. And also we need to factor in the US Federal Reserve, who have pumped trillions into financial markets and will continue to do so as they need to moving forward. So really that's underwritten stock markets over the past few months, and that support isn't going to go away anytime soon. So when we're looking at the situation, we don't think that we'll see a retest of those March lows, because we have seen the US Federal Reserve step in. I think markets have moved a little too far too fast, so we wouldn't be surprised to see a period of consolidation potentially over the summer. And then assuming that the global economy is continuing to strengthen again, then there'll be scope for US stock markets to move higher. If we're looking at valuations, I think the key point to make is that actually the US stock market in particular is not cheap, but then we're not constrained to just investing in the US stock market. Actually, there are other regions around, and actually one of our conclusions is that actually regions outside the US may start to outperform. And actually we're very interested in Europe at the moment. We've increased our exposure to there for a number of reasons. Firstly, Europe's much cheaper than the US. Secondly, it tends to have its stock market tends to be more cyclical. So if we do see that global recovery coming through, actually the European stock market should do quite well as a result of that. And actually a key point is that over the past couple of days, we have seen the formation of an EU recovery fund, which is basically the European Union moving towards a fiscal union. That is undoubtedly a very, very positive development as far as Europe is concerned. So that's certainly one of the areas that we're looking at. The other factor that we need to take into account is what parts of the stock market do we think offer the best value. It is noticeable that over the past 10 plus years, value stocks, so mainly those on the financials and energy side, have significantly underperformed other areas such as technology, to the extent that actually the valuation gap there now is as wide as it's ever been. Increasingly we're starting to look at those value areas, but the issue is that obviously undervaluation can persist for a long period of time. I could have made this point very easily this time last year. The value stocks looked very undervalued. The fact is they've got even cheaper over that time. Global bonds, I think, will remain quite well supported, with interest rates and inflation likely to remain low. And the other key point to make is gold, which has been performing extremely well. It's benefiting from the fact that interest rates across the world have been cut to zero. Typically there's an opportunity cost from holding gold, which is no longer the case. So again, with the uncertainty that we're seeing at the moment, gold, I think, remains or certainly remains a key pillar of many of our portfolio strategies. So to wrap it up before we open to Q&A, recovery or relapse, I think the answer is yes. We will see a recovery, but we could also see a bit of a relapse. It's one of those imponderables at the moment, and it really depends on how those forces play out. On the recovery side, the fact is that we have seen that massive stimulus from governments and central banks. We are seeing lots of resources deployed in the search for a vaccine, and the fact is inflation is going to remain low, and many economies are starting to slowly reopen. On the downside, why might we relapse? Certainly the economic damage that we've seen isn't necessarily just going to fix itself overnight. Be a little bit careful about those hopes for a vaccine. It might be slightly too optimistic in the short term, and just be aware of some of the quite rich valuations that we're seeing in certain parts of the market. So particularly in terms of the NASDAQ, for example, which is more technology oriented, it's up 34% over the past 12 months. It's significantly higher. That's not normally an indication of a bear market, which are normally take more than 4 weeks to resolve themselves. And moving forward, the US election is something we'll have to keep an eye on, as well as the tensions with China, which only seem to be increasing. So hopefully that gives you a sort of snapshot of where the world is at the moment, some of the questions that we need to answer. We haven't necessarily got the answers to them at the moment, but I think we have to be focusing on those particular questions before we can implement the appropriate investment strategies. So with that, Rich, I'll open it up to if there's any questions coming through.
Thank you very much. We currently don't have any questions coming through, but there may well be that people are waiting to drop a line to their wealth managers. You can also contact people on the central invite if you've got any questions. Oh, here we do actually have a chat, a question. Are we, I think as a company, going to hold more gold?
Hold more gold? No, we've already got quite a significant exposure, which we have done for the past sort of 12 months. And gold prices clearly have already risen significantly. As I'm looking at it right now, about 1850 an ounce, which is up from about $1,500 at the start of the year. So we're quite happy with our positions at this moment in time, but we'll keep an open mind on it. I don't think we'll be piling into or increasing our allocations to gold at this moment in time. I think we still expect stock markets to deliver reasonable returns over the next 24 months, with a bit of volatility potentially in the summer. But I think it's good to have there as a portfolio hedge.
Okay, thank you, Justin. And just an addendum to that question, what are our thoughts on healthcare sectors at the moment?
Yeah, we still really like healthcare. As many will be aware, we've had exposure to healthcare over a number of years. Valuations in the healthcare sector themselves are still reasonable, despite the fact that that sector of the market performed so well this year. And if you look at it, there's a strong correlation between, unsurprisingly, healthcare spending and the performance of healthcare stocks. And I think if there's one key thing we can take out of this coronavirus pandemic, is that healthcare spending is only going to go one way, and that's upwards, whether it's in terms of individuals making sure they've got their full healthcare coverage, or whether it's governments spending more in terms of healthcare, making sure that if we go through this again, that our healthcare professionals have got access to PPE, making sure that they've got those testing, tracking facilities available. Healthcare spending, it seems inevitable that it's going to go up in the future, and that's got to be a tailwind for the healthcare sector as a whole. And that's even before we consider things like the potential for a vaccine moving forward. Again, we have no particular insights in terms of those vaccine hopes, but actually we have to be aware that it has driven certain share prices in terms of either AstraZeneca or Moderna over the past few weeks. So healthcare, we're still in favour of.
Okay, thank you, Justin. Thank you, Wendy, for those very appropriate questions, very relevant. And we've got another relevant one from Peter here. ESG is a theme being discussed at the moment. What areas are you looking at from that perspective? That's very, very timely, Justin.
Yeah, that's a very good question. Very good question indeed. Yes, we have increasingly adopted ESG principles as part of our overriding investment process. We're a signatory to the UN PRIs, which effectively establish those sort of ESG credentials. And we've also increased our distinct exposure to ESG themes. Within some of the funds that we've managed, we've incorporated a weighting of sort of 9 or 10% at the moment, and there is a clear direction of travel which will be to increase that weighting moving forward. The areas that we've done, we've tried to combine different elements of the sort of the ESG universe, if I can put it that way, into sort of one whole area, which hopefully stands the chance of outperforming in both up and down markets. So that includes an exposure to oncology. It includes exposure to waste and water. There's an environmental fund in there, as well as cyber security and batteries, all of which are themes that actually we think the world is increasingly going to focus on over the coming sort of weeks or months. And actually it's done very well for us since we put it into our portfolios earlier on in this year. And again, we are looking for opportunities to increase that weighting further, as well as sort of broadening out our general process in the ESG area. So increasingly ESG is becoming part and parcel of our standard investment process, and it's only going to go one way. And actually, people have come to the conclusion that actually you can invest in an ESG friendly way, as well as making very good returns from your investments. It might have been a case a few years ago where you had to sacrifice the return element for your ESG principles. Certainly the moves that we've seen over the past few months and the flow of funds show that actually you can invest responsibly and also generate strong returns with that.
Okay, thank you. ESG, very, very timely.
Yep.
this time, and watch this space at some stage this year from CGWM. A shameless plug there as well. An addendum from Peter, being based in the Middle East, where do you see the oil price over the next 2 quarters?
Yeah, I'm always so reluctant to give oil price targets, because I just think it's such an opaque market. And you know, even I've been doing this job for 26 years now, and the number of people who have ever been able to call the oil price consistently, I can probably count on the fingers of one hand. And this is even people who just spend their entire day looking at the oil market, sometimes come out with astonishing wrong figures. Again, it partly depends on what happens with the global economy moving forward. I think if the global economy continues to strengthen, then it's reasonable to expect that the oil price will move stronger, or move higher in tandem with that. Clearly, if we get a second wave of coronavirus, or the situation spirals out of control again, then we can expect oil prices to remain very weak. There have been cuts in terms of the production from OPEC recently, which kind of leads me to suspect there will be a general move upwards in the oil price, potentially over the rest of the year. But I would always caveat that by saying I'm not an oil expert, and I take any forecast on the oil price with a large pinch of salt.
I thought that would be the answer, Justin. There's been a consistency in your approach for many, many years on that. We don't actually have any more Q&A at the moment. As I said before, if anyone would like to follow up with any questions or answers, if you can go through your wealth manager, and Justin and I are very, very happy to pick those questions afterwards. Alex, can I hand over to you now?
Yep, of course. Thank you very much, guys. Really informative. Hope everybody on the webinar found it useful. So yeah, on behalf of Holborn, thanks for your time, and I look forward to seeing you both again very soon in person, hopefully.
Yes.
Indeed.
Yeah, that'd be
Let's
good.
hope so.
Yeah.
All right. Cheers, guys.
Thank you very much. Thank you, everyone.
Bye.
Cheers. Bye now.